business owner buys an HVAC company for $850,000. Revenue is $1.4 million. The seller showed $220,000 in annual profit. After closing, the new owner does the right thing. Hires a bookkeeper, keeps the books clean, every invoice entered, every bank account reconciled. 6 months later, accounts receivable has climbed from $70,000 to $180,000. Equipment repairs have spiked. Summer payroll has increased, and the cash balance is below $20,000. Payroll is late by 3 days. The owner calls the bookkeeper. The books are perfect. That is exactly the problem. The owner hired the right person for the wrong job. There is a 5-part framework called the financial stack, and it explains which financial professional solves which problem, what each one actually does, and why buying the wrong seat is the most common and most expensive financial mistake small business owners make. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Here is what most business owners actually believe when they buy or run a small business. They know they need financial help. They hire someone. They assume that person has it covered. What they do not know is that a bookkeeper, a controller, and a CFO are 3 completely different jobs built to solve 3 completely different problems. Expecting one to do the work of another is not a minor inefficiency. It is how a business with clean books ends up with empty accounts. The confusion is understandable. The titles overlap in casual conversation. People call their bookkeeper their accountant. They call their tax preparer their CFO. They describe anyone who touches the finances as their financial person. The roles have real boundaries, and when those boundaries get blurred, the gaps between them become expensive. The HVAC owner did not have a bookkeeping problem. Nobody was forecasting cash. Nobody was watching what was coming. The financial stack, 5 layers, the foundation, the controller layer, the navigator, the right seat, the upgrade path. Each one solves a different problem. Each one depends on the layer below it. Layer 1 is the foundation, and the foundation is bookkeeping. Bookkeeping is the legal and operational baseline of every business. The IRS requires that your records clearly show gross income, deductions, and credits, supported by source documents like invoices and bank statements. The job is recording and organizing transactions so the financial record is clean, complete, and accurate. That is the entire job. A bookkeeper is not a strategist. A bookkeeper is not a forecaster. A bookkeeper keeps the score. The single biggest mistake at this layer is hiring someone unqualified. An unqualified bookkeeper creates problems you cannot see until they are expensive. Bad records corrupt every financial function built on top of them. A controller cannot oversee what is not accurate. A CFO cannot forecast from unreliable data. For the HVAC owner, the bookkeeper was doing the job correctly. Transactions recorded, accounts reconciled, records clean. The problem was not the bookkeeper. The problem was that nobody above the bookkeeper was watching where the business was headed. The standard for this hire is straightforward, certified in a primary platform like QuickBooks, experienced with your type of business, and doing only bookkeeping, not a split role. A remote bookkeeping service typically runs a few $100s a month and often delivers more consistent quality than a part-time local hire. A dedicated full-time bookkeeper on payroll is more likely a $30,000 to $35,000 annual position. Either way, the person doing only bookkeeping, doing it well and qualified in the software, is the baseline the rest of the stack depends on. Layer 2 is the controller layer. Most owners call this person their accountant. The function is controller, and the distinction matters. The controller reviews the books for accuracy, produces financial statements, oversees financial reporting, and manages the relationship with the tax preparer. A CPA credential is valuable at this level. It is not the only path. What matters is experience, judgment, and someone you trust to give you an accurate picture of the business. Here is the point most owners miss. The tax CPA is a compliance function. A return filed 4 to 9 months after year-end tells you what happened last year. It does not tell you what to do next month. Owners who treat their annual CPA meeting as their primary financial review are flying blind for most of the year. For the HVAC owner, a controller reviewing monthly financials might have noticed the receivables trend building by month 3. The score was right, but nobody was reading it closely enough to ask what it meant for cash 4 months out. Layer 3 is the navigator, and the navigator is CFO services. This is where the HVAC story gets resolved. The CFO uses the numbers to make decisions. Cash flow forecasting, hiring capacity, pricing strategy, growth planning, debt management, KPI design. These are not accounting functions, they are planning functions. The CFO's job is to tell you what happens next and what to do about it. But here's the part most owners never hear. The CFO is not just protecting you from problems. The CFO is the person helping you grow the business and make more money. Every what-if question you have ever had about your business. What if I add a second location? What if I raise prices? What if I hire 2 more technicians? What if I take on more debt? Those are CFO conversations. The bookkeeper records what happened. The controller confirms it is accurate. The CFO helps you decide what to do next and models out what it actually costs or gains you before you commit. That is the function most small business owners are missing entirely. The bookkeeper recorded every transaction on the HVAC company correctly. The controller would have confirmed the statements were accurate. Neither one was responsible for noticing that a business doing $1.4 million in revenue, carrying $765,000 in acquisition debt with a clear seasonal pattern, was accumulating receivables at a pace that would drain cash before summer payroll hit. That is a forecasting problem. That is a CFO function. A fractional CFO brought in at or shortly after closing could have built a 12-month cash flow model in the first week. That model would have flagged the receivables risk, identified the seasonal payroll exposure, and recommended arranging a line of credit before the crunch arrived. That same CFO would also be running growth scenarios. What does the business look like if revenue grows 20%? What does hiring a service manager do to margin? When does the debt load allow for a second truck? That engagement might have cost less than 1 month of the financial chaos it would have prevented. For a business in the $200,000 to $2 million range, fractional is the practical entry point. Not a full-time hire, not a 6-figure salary. A small package of hours per month focused on cash forecasting, lender preparation, line of credit planning, hiring analysis, pricing decisions, and growth modeling. One rule holds at every level of the stack. The CFO cannot function on bad inputs. Clean books first, accurate oversight second, planning third. Skipping layers does not accelerate results, it guarantees bad ones. Layer 4 is the right seat, and this is the answer the whole video has been building toward. Most business owners experiencing financial pain are not missing financial help. They are paying for the wrong kind. Clean books do not prevent a cash crisis. A tax return does not tell you whether you can afford to hire. A controller cannot build a forecast. Each role has a lane. The mistake is expecting one lane to cover the whole road. The decision filter is straightforward. If the problem is records and organization, the foundation needs attention. If the problem is accurate financial statements and someone overseeing the numbers, the controller layer is the gap. If the problem is decisions, cash, growth, financing, or planning, that is a fractional CFO conversation. The HVAC owner had a perfectly functioning layer 1. What was missing was layer 3. The cash crisis was not a bookkeeping failure. It was a planning gap. That one distinction, understood at closing, changes the entire outcome. Layer 5 is the upgrade path. Most businesses start with a qualified bookkeeper. As complexity and debt load increase, the controller layer becomes necessary. As strategic decisions multiply, CFO-level input becomes the highest return conversation in the business. The mistake is waiting for a crisis to trigger the upgrade. The diagnostic is simple. What problem are you actually trying to solve right now? Records and organization points to the foundation. Accurate reporting and oversight points to the controller layer. Decisions, cash, growth, and financing point to a fractional CFO. That question, answered honestly, tells you exactly where the gap is and what the next hire should be. Here's what to take away from this. A bookkeeper, a controller, and a CFO are 3 different jobs that solve 3 different problems. Hiring the wrong one for the wrong problem is the most common financial mistake small business owners make. An unqualified bookkeeper creates problems you cannot see until they are expensive. Bad records corrupt every financial function built on top of them. Certified in the software, experienced with the business type, doing only bookkeeping. That is the standard. Your tax CPA is a compliance function, not a planning function. A return filed months after year-end tells you what happened. It does not tell you what to do next. For a business carrying acquisition debt or managing seasonal cash flow, a fractional CFO can deliver a cash flow forecast, a set of KPIs, and a line of credit strategy before a cash crisis arrives. That is not a luxury. For most acquisition buyers, it is the most important hire they are not planning for. Business complexity determines which layer you need and when. A simple service business may run well with a qualified bookkeeper for years. A construction company needs controller-level oversight from the first day of operations. Bookkeepers tell you where the money went, controllers tell you whether the numbers are right, and a CFO tells you what to do before the money runs out.